Right. So today we have Lemonade earnings. We've got a couple different things to talk about in the Tesla world. And I did notice that we're running a few minutes late today, Bradford. I know you were behind schedule. I'm wondering, were you running some Uber Eats deliveries in order to do some firsthand Robotaxi research?
Yeah, I was. I did some Uber Eats around lunchtime, did some driving, took someone to T-Mobile for them to redo their contract because they just got a new job. So they're getting their phone activated again, and then took them back to their job. So here I am. It got to see how the car is driving for one, but also try to gauge potential Robotaxi customer opinion about it, because essentially I have a new Model Y. It's driving in full self-driving, and so they can see it, and I can get their live reaction to it.
So I think that's been kind of eye-opening. You posted a little bit about some of the reactions when you were, actually doing Uber, not Uber Eats.
Mhm.
So maybe can you share a little bit about why you've been doing this and what are some of the insights that you found? Because I think I'll tee it off here a little bit, and then you can take it.
Yeah.
But I think most people think of like Uber. I think maybe most people who'd be watching this stream anyways think of Uber and they think, okay, like that's what I use when I'm traveling, or
Mhm.
as you've mentioned in the past, like if I'm having a night out in the town and just want to get back safely. So it's kind of like almost like a luxury thing or a thing that you use not very often. Doesn't seem to be very sensitive to price, and therefore the TAM is not that large, and it's going to be somewhat niche. So when I see the Gary Blacks out there of the world kind of commenting about like how everyone else is going to have this same technology in a matter of months, and Tesla doesn't really have anything differentiated on here. I think that's probably misguided, because I think the TAM is going to be a lot bigger than people with this kind of mental model are thinking about. So maybe with
Mhm.
that, you can talk about the normal types of riders that you're getting as you're doing some Uber drives.
Yeah. And I I think some of the skepticism is around how good Tesla's system already is today. So Matt and I, we think they're closer to maybe one safety critical intervention every 10,000 miles, whereas people look at the community tracker and they think it's closer to one every 1,000 miles. Our experience on version 13 is really good, and safety critical in our minds means like you're slamming on the brakes to prevent an accident, that type of thing. So not where it's doing some unsafe, but
Yeah.
something where it's almost nearly getting an accident. So a lot of the clientele for Uber and Lyft are working class. They're blue collar, often working in pretty low wage jobs, like close to minimum wage jobs. So taking uh, helping people with their commute, going to fast food jobs, in-home care, where they're helping out people as like a, not necessarily a nurse, but more like a in-home care person, um, things like that. So uh, it's a lot of working class, and so I thought that they would be a little more price sensitive, and if Tesla could offer a discount, because with Tesla self-driving, you're getting rid of the driver. Essentially, you don't have to pay the driver. So if Tesla can offer a discount on what Uber's doing, that people would really want to take Tesla up on their offer. But some of my polling surprised me a bit.
Yeah, so let's talk about that. I mean, if someone is let's say a minimum wage earner or something close to that, and they might be spending, let's say, $20 round trip on Uber to get to their work, I mean,
Mhm.
you're giving up, like 1/8 of your of your daily salary just to
Mhm.
Uber, to transportation, which seems kind of shocking. At the same time, as a like Tesla investor, that does seem to create quite a bit of opportunity where you could undercut Uber on price and potentially pick up a lot of that market share. Then beyond that, if this really is, if people would have to give up like an hour's worth of labor potentially to use Uber, I would imagine they'd use it a lot more if it was priced, half as much, which Tesla has the competitive positioning to be able to do. So yeah, with that, maybe we can talk about some of your experiences and the price elasticity a bit.
Yeah, so I'll be toward the end of a drive and maybe my style is off or something, but I'll say, hey, the car's been driving this whole time, what do you think? And they maybe weren't really paying attention to that. They were just kind of like zoning out for the drive. And then I'll ask them, if one of these pulled up to you like as a Uber and there was no driver inside, would you accept the ride? And surprisingly to me, like they see it working and they just have this quick snap reaction of nope. They don't feel like it's safe for some reason, even though they're experiencing it firsthand and it's like doing a good job for them.
Do you think they are thinking that you must be doing something because maybe if they weren't watching as closely, maybe they clearly must think you've got to be doing something valuable there if that's their reaction. So is it your sense that they're just not paying closely and they didn't even notice maybe that your hands are in your lap, or is it just such a visceral reaction that like, no, I don't want a computer to be in charge of my safety?
Yeah, they for some reason a chunk of people just think it's not safe. There are some people who are
body is telling them like that's
there are some people who are more blown away by it. So they're fascinated by it. They're like, wow, this is awesome. And what I'd say what's disappointed me and made me think like there will be an adoption curve to this is my next question will be like, okay, well, what if it's half price? Like, would you do it then? And it's again a very quick note. So I think I'm going to test it out some more. I did take someone from their job to like get their T-Mobile thing done and back. And I asked them, I said, if there wasn't a driver here, and then I framed the question a little differently, and you weren't getting in the car with like a man, so this was a woman, would you do it? And they said yes, and they said absolutely, and they said, oh, this is cool. So
yeah, well, I'm not sure that I think that that's necessarily indicative of what the rollout's actually going to look like. I think what it does highlight importantly is that there's going to be some serious mental hurdles for a lot of people. So it's not the sort of thing that like Tesla just launches and boom, there's like maximum capacity utilization over 1 million robotaxis. I do think there's going to be some growing pains in terms of customer adoption and people just changing their behavior. That's not the sort of thing that happens overnight. So that's what I think is pretty helpful that you're highlighting. But at the same time, I think like if you ask someone that, I think it's very reasonable to think that their gut reaction will just be like, nope, don't want that. Sounds scary, too dangerous. But if instead it's like, well, what if if you're a woman, you don't have to worry about a man, that whole situation. And for all riders, if you can just like watch Netflix or like do some work or whatever, like all of a sudden, I think if you start phrasing it a little bit different, and then it's not only that, but it's half the price. That's where I think this market's going to be a lot bigger. We've spoken about this in the past, but Uber did some testing where they got the price down to, was it $1 per mile?
Yeah.
And what they found was that the TAM increased by 20x, which is
20-fold.
20-fold increase in demand. So when we built up our model, and I'm thinking we should really do a deep dive in robotaxi economics. We haven't done that in a while, but I was kind of losing my mind with some of the comments I was seeing on X this week. Like James Catt had one about like how it doesn't matter like if you pay $100,000 for a vehicle or like 25,000
or 150,000 versus 25, like you have to depreciate 150,000 over 150,000 miles or whatever it's going to be. Like, it does matter. Like, that's $1 a mile
It's a
that you're paying
massive.
for the hardware.
But like, and he's someone who is very reasonable. I respect a lot of his views, and has been like very good kind of in neutral Tesla analysis, which is what we try to do. Like, not only being like uber bulls.
Yeah.
But when I see comments like that, I'm just like, that makes zero sense. Like, okay, you can say that it's only a 40 cent per mile impact or something like that, and then you can make the case that that doesn't matter. But I think in the long run, having a 40 cent per mile disadvantage is going to be deadly to your business model. I don't think you can survive in the long term if you don't have the lowest cost. And it's not only the lowest cost of the hardware, it's also like the most efficient in terms of kilowatt hours or miles per kilowatt hour. And in like the lowest cost kind of sensor suite and everything like that. So putting the whole package together, I think is where Tesla is going to have this like massive advantage where, I think conservatively we'll be able to charge like 60 cents per mile and still be profitable and still have it be profitable for Robotaxi owners. We've run some math on that. And so if you can get to that level, then maybe
I don't think they even need to. Like, if your TAM 20x is at $1, like at $1.50, it's there's going to be a ton of demand there. They just may not be able to suddenly go to 1 million robotaxis on the road because some attitudes need to change. People need to feel like they're safe. I think people haven't thought through like all the benefits of not having a driver. So like, I think one of them is you could play whatever music you like. It could have curse words in it or whatever. Like,
you can blast it. Like,
loud.
people are very conscious of their volume too.
You can blow out the bass, whatever. There's all kinds of different things you could do where you don't have to deal with, the driver may not like that, or you can talk loud on your phone and whatever you want.
Yeah, so I agree with that. But so I do think even at 1 million vehicles, though, there's going to be a decent amount of a kind of runway. But this is why I think we probably want to do a separate video at some point, because one of the things I've started doing in our base case earnings per share model is looking at, okay, what's the fleet of robotaxis that Tesla has, kind of growing over time from like almost nothing, in Q2, Q3, gradually to a couple thousand, then a couple 100,000, and eventually like 1 million and beyond. But then if you like assume a certain number of miles per quarter, then you can kind of derive what percent of Uber's total like annual miles driven are you assuming at this price point. And so it's a good kind of mental check, I think, to say, okay, if we're going to assume that we're 100% of Uber's miles driven in a year, we've got to be like meaningfully lower than their number. Now, given the elasticity that you talked about, 20x at $1, like you probably would be like completely comfortable at $1.50 per mile. But I think it's a reasonable check, and I think it's a balanced way of kind of thinking of the rollout. So I think we want to share that in a little bit more detail, because I've been getting like annoyed at the level of discourse around some of the robotaxi stuff. I think people
aren't talking about like the unit economics and like how profitable this will be. It's more like, it's, I don't know why people aren't talking about the unit economics. It just doesn't make sense to me.
It all comes down to the unit economics. One of the things we've also done is like we look at it from every perspective. So we look at it from Tesla's perspective, like how much is it going to contribute to their earnings per share? How many FSD licenses are they going to sell? All that stuff. But then we use those same inputs and look at it from the robotaxi like fleet operator, like one that's not company owned, and say, okay, at these pricing points and with like ASPs coming down over time, does it still make sense to buy a robotaxi in 2025 or 2026? And then at lower price points, does it make sense? Like, let's assume like a total saturation point where pricing is at 60 cents per mile. Like, what do the economics look like then for Tesla and for a fleet operator? So we've looked at it that way. And then, as I said, we're looking at like the overall TAM as well to make sure that we're not just assuming, there's 50 million robotaxis doing like 100,000 miles a year, and you get like some crazy number. Like we're trying to keep all these things in check, make sure that all the assumptions make sense individually, but also holistically. Because like you can very easily like run a scenario where like Tesla's like worth $15 trillion based on robotaxis, but if you run your same economics on like the fleet operator, you'd see that their IRRs are negative. And so you say, okay, well, that's not a realistic solution then, because they're not going to be willing to pay you $30,000 for an FSD license,
right.
If that kills their economics. So you've really got to look at it holistically, and that's what we've tried to do. And the thing that I get so excited about is when we literally turn over every rock like that, it's the economics are still phenomenal, and there's still so much room, I think, for Tesla to grow. So I'm pretty pumped about this, but I do think there's a lot of misconceptions out there. So maybe we'll take
people
that.
Have misconceptions about the cleaning that's needed too. People think that like every robotaxi ride is like a Minecraft chicken jockey popcorn explosion in the back seat, or like
someone pukes in your car every third trip, right? That's the assumption.
Yeah, like some massive risque encounter that happens in the back there with unmentionables, and like that's not been my experience. I had someone, they went to like a Chinese festival or whatnot, and they got like some soup and they spilled it on my WeatherTech map, but like that wasn't a big deal. I just like soaked it up with some napkins, but like other than that, like there's been no mess in the car. That's I'm not quite at the level of JC's rides, but he's someone that's doing a bunch of Uber driving right now. But yeah, I think it's the concerns about like cleaning the car are overblown as well.
So a lot to be excited on for Tesla. Relatively quiet news week for Tesla. So let's maybe shift our attention to Lemonade, which announced earnings this morning and had their earnings call. Kind of a wild day in the markets overall, but for Lemonade too. I think it was up like 10, 12% pre-market, something like that. Kind of faded throughout the day, turned red for a while, and then like finished back up. So it was a bit of a crazy day, but let's just talk about the economics. The high level before I share this customer deck, I think it was just another point that kind of validated our long-term thesis. There were no like super flashy numbers. I think there's frankly never going to be with Lemonade. There really are just like a kind of steady head down, make progress every quarter incrementally. And when we like run these economics forward several years, it seems pretty clear to us that the stock is undervalued. Not financial advice, but with the analysis that we've done, it's a company that we really like. But let's take a look at this quarter, and there we go. Thank you, Jordan. So here's their investor letter. I mean, one of the things you can see here is just kind of like how quickly they're growing. So this is their in-force premium. So how much premium the company has written, and you can just see from 2 years ago at 663 million to finally crossing the $1 billion mark this quarter. The growth rate's been pretty phenomenal. The gross profit margins, which were a concern for a while, have finally leveled out. I guess I was pointing to stuff with my mouse, and I'm realizing you guys can't actually see, but this chart on the bottom left here, you can see is really leveling out. Their first quarter cash flows on the bottom right are generally negative, but most of the rest of the quarters are going to be positive and pretty significantly positive. So this is a company that already is cash flow positive, but they've got a little seasonality that impacts them on Q1. So let's move forward here. Some of the charts that I think are a little bit more compelling. So this is their year-over-year growth rate of in-force premium. And so what you can see is like this is the growth rate is obviously a derivative, but like the derivative of the growth rate is like the acceleration of growth. And what you can see is the growth rate itself is accelerating up and to the right. So that's pretty exciting. A key to our whole long-term thesis is they've got too much cost right now, so they need to kind of grow into their operating expense. Now I don't think it's like a problem that they've got too much cost. It's just that their net profit is negative right now. So in order to get to the point where they're significantly positive, they really need to grow the business. So that's the kind of main concern. is that this trend kind of continues where they're growing at probably, I think it'll probably level out around 30% or so in the next couple of years, but we'll see. But that should be sufficient to get them to profitability by 2028, I think at the latest.
Well, Matt, I think some of the lower growth rate in the past has been a result of them giving up some policies where they left a lot of policies in car insurance, for example. They quit some policies in homeowners insurance, which really benefited them as well.
Yeah, so there's definitely been a bit of that, which hurt the growth rate. But also a couple of years ago, they kind of intentionally took their foot off the gas, was the metaphor they used. This was when interest rates started going up for the first time, and their kind of cost of capital equation changed. With insurance, it's extremely important that you don't run out of money. So you want to make sure you've got ample buffer. And so they kind of intentionally decided to kind of throttle back on their growth spend for, it was probably close to 2 years or so. Maybe about a year ago, they said, we're ready. We've got sufficient cash now, and we're cash flow positive. So it's actually time to kind of re-hit that accelerator. So you also have a kind of reversal of that trend now. But what you can see kind of when their loss ratios were here, and so for those who are less familiar with insurance, the loss ratio is how much are you paying out in claims for every dollar that you bring in. So it needs to be less than $1 or less than 100%, obviously, because you need some margin left over after you're paying out all your claims to pay for all the costs of the business. But when your loss ratios were here in like the 80s and 90s, didn't make sense to be spending as much. But now that your loss ratios are down here, their target is like 75%. So they're basically at their long-term target, and I think they'll actually do better than this going forward. But since they're right here, it makes a lot more sense to start spending a lot more in growth too, because your customers are a lot more profitable when the loss ratios are 73% than when they're 85%. That makes a huge difference. But I think the most compelling,
they're also in a range where you want to be as an insurer. So like low 70s is a really good spot to be in.
Yeah, like, your inner capitalist might say like, oh, let's get it to 40% or something. But then like, at that point, you're just ripping off your customers, and the regulators don't like that. So this is a very kind of healthy point to be. And they break it down by product line further down, which we'll get into in just a second, to kind of show what's going on there. But this is overall a really good result. And I mean, a couple of years ago, the knock on the company was that their AI is not actually that good, because look how high their loss ratios are. You can see now, like their AI, I think, deserves very serious credit for how good it's become at pricing. And their AI is not just for like pricing and risk assessment and that sort of thing. You can see on this bottom chart here, this is a comparison of their in-force premium, which is that line that's kind of going parabolic, or maybe not parabolic, but at least exponential. And then comparing that to their operating expense, excluding growth, and that's an important caveat that we'll come back to in a second. But you can see that's essentially flat. They were at $87 million in Q3 a couple of years ago. They're at $89 million now, so essentially flat. What that means, and what management has been like shouting from the rooftops on, like mostly has fallen on deaf ears, is that like they are using their existing employee base and like technology stack that they developed in-house to do more with less. So they're serving like almost twice as many customers, not quite that severe, but managing a much larger book of business than they were 2 years ago, with the same level of spend on employees and technology and all that. And if you listen to their earnings calls and Investor Day, and I follow their posts, you can understand all the stuff that they're doing, and it's like real legitimate AI development that they're using, and kind of like focusing back inwardly on their business so that their own employees can become a lot more capable. They're also doing some pretty impressive stuff on the customer service side to have automated responses to email, and they're just now starting to roll out like a voice assistant. So if you call in, there's like a ChatGPT integration with the ChatGPT voice, so it can like give you a great outcome on an issue that you might be calling about. So they're being extremely lean with their operating expenses. but at the same time, they're not sacrificing quality and kind of like customer satisfaction while they're doing that, which I think is really important. Now,
let me just mention real quick about their voice assistant. So when you call into this, and I think you can use the app to call into it, which is cool. You can just do it right on the app. But what it does is it's connected to Lemonade systems. So when you want to do something, whether it's like adding another pet to your insurance or taking a car off your insurance or whatever, not only can you tell it what you're wanting, it can give you a quote. You can agree or not to that quote. And then it can say, like, do you want me to use the same card on file? And then they'll just do it for you. Whereas a lot of voice assistants, they might talk you through like how to use the app. They might help you like with a FAQ type thing, but it doesn't actually do anything in their system. So that's like a really big difference as far as removing friction for the customer and delighting them.
Yeah, that's a super important point, because I mean, if it's just like I think a lot of these like kind of help wizards, that are some of these other models, it's kind of like an upgraded version of Clippy, which is like, let me help you with that. Like, I'll show you what to do, but I can't do it myself. Actually being able to, when people call in, they expect the agent to be able to handle updating their credit card information or adding a new pet to their policy. So like Tesla even showed a version of this, which was kind of similar to what you said, where, it like showed you how to do something, but it didn't actually do that thing. And Lemonade has, very importantly, they built a deterministic model rather than a probabilistic one. So they know exactly how it's going to behave. If a customer talks about adding a pet or something like that. Now, maybe the exact words, they won't be able to tell exactly how it will phrase it, but the action that it will take and like the type of response that it will give, that's done in a deterministic way. So it's not going to hallucinate some crazy thing and, give an answer that has a 1% chance of like being wrong or doing the wrong thing. So that's a really key difference. And I think it's something that people don't necessarily appreciate.
Matt, I'm curious, can we hit the pause button here and talk a little bit about our AI spend and like how we're getting more efficient?
Yeah, let's talk about that.
All right. So we just hired a full stack developer to help us implement upgrades with our software at work. So we have data, we have systems for trading and are working with our clients, things like that. And our full stack developer basically works with AI to write the code, debug the code, and then get that into production so that we can use it on a daily basis. And so with the first project they did in like 2 days, I think it's gonna save you and me like 100 hours or more of our time, maybe a couple hundred hours over the next couple of years. Then there's another thing that you do. So like we do cover calls for clients at rebellionaire.com. We do that on a weekly basis, and that coming up with the data or the numbers for that, that's something that you said takes you about an hour a week or more.
Yeah, and we have dozens of clients that we're doing this for now, and so it's like every week we've got to make sure that we've got the number of Tesla shares that everyone owns, so that we're not selling too many or too few contracts. We've got new clients that we're adding pretty regularly, so we've got to make sure that we're like including them in this list. And it was basically a type of process that started off super easy, because it was like, we start with maybe 5 or 6 clients to begin with. It's like, it makes all the sense in the world to just do that manually and like with an Excel spreadsheet. But then as that grows to dozens, like the complications and the time that it takes and the opportunity for error potentially, just increases. So, it worked really well so far, but it's getting to the point where it's like, just taking too much time. And I think one of the things we really want to do is minimize the probability for error. So that's going to be really helpful to just automate that. So, I can't fat finger something or accidentally delete a cell or something like that.
Yeah. So we think implementing AI to do something that's like a killer feature for your business. Like if you have data in your business and processes, you can use AI to help you code it, but also help you automate it. So what's crazy is like the software, they have a development team. They've been doing this software for
The software vendors, you mean?
yeah, for probably like 10 years, but we're like creating new ways to see the data that's much more useful to us, or to process and work with the data. So we think this is a big opportunity for folks. But what we're seeing with Lemonade is they're implementing it, like you said, for their employees, making them more productive. They're kind of like AI shepherds at Lemonade.
Yeah, which I think is super cool. So like, I mean, you can kind of look at investing in something like this in a couple different ways. I mean, you might say, and we've had this conversation, like, okay, you're adding an expense, like how can you actually justify that? I think there's probably two ways you can answer that. The first would be like, you kind of quantified the savings of this one particular process, and so that frees up our time, which is valuable, and probably allows us to scale a little bit better than we otherwise could. So like there's that kind of dollars and cents way that you can quantify it. I think the thing that strikes home with me a little bit more is like qualitatively. I think if you're not using these tools, you're going to get left behind in the workforce. I think if you are not using AI on a regular basis and like following how closely it's developing, I just think that there's a decent chance you get run over. And I don't say that lightly, and I don't take any kind of joy in doing that, in saying that. But I do think that it's the sort of thing, it's going to be so deflationary that, I think like if you want to kind of justify a salary or something like that around your current level, in what could be a extremely deflationary environment, then you need to like up level your skills and kind of stay at the cutting edge of what's happening. So that's my advice for anyone who might be watching this. There's, regardless of what you're doing, I mean, I'm sure every company has its own policies and restrictions about what you can do, but there's definitely things you can do either at your work or just personally to kind of stay up to date on what's happening. And I'm blown away by how helpful it's been on the research side with a lot of the stuff that I'm doing, analyzing companies. And we probably won't get into that today because there's a lot that we don't want to talk about publicly and with a particular company that we're looking at. But like it is just, it's been like having an entire team of like research assistants that have helped me like go super deep on like some super nerdy stuff that I actually feel like we've got an advantage with some of the information that we have, because like we're going deeper and deeper and deeper, and it's a very big deal.
Yeah. So we'll get off our soapbox for now, and let's get back to Lemonade, Matt.
Yeah. So I think where we left it off with Lemonade, Mayor Thacker actually had I was trying to pull this. Jordan, can you put the thing back up? There we go. So I posted out this bottom chart on X today, basically saying it's the in-force premium compared to operating expense, excluding growth spend. And the mayor basically said, okay, well, yeah, but like the caveat there is you're excluding growth spend. So I'm sure like every company looks great when you exclude growth spend. It's, it's basically like an adjustment of, it's not even like adjusted EBITDA. It's like an additional adjustment on top of like what would normally be calculated as like adjusted EBITDA.
Right.
And like that's a fair criticism at first glance. But I think when you really understand the company a little bit more deeply, or if you just think about it, like what is this chart actually trying to show? It's trying to show the core, like the true overhead of the company, like the actual like people working in buildings and technology, like all the cost that it takes to like actually run the business. Marketing spend, growth spend doesn't fall into that bucket. It's
optional.
It's completely optional. They could completely dial that back and make their financials look a lot better. Or they can really crank it up, which is what they have been doing in the last several quarters, to reinvest in the long-term health of the business. But like,
so
if you
financially, why would you do that, Matt?
well, so you would invest in the growth of your business if it's a positive to the NPV of your company to do so.
What's MPP?
To the net present value.
Okay.
And let's take a quick detour to talk about the net present value of Lemonade's growth spend. So they spent it was just under $40 million this quarter on growth, which is a lot. But what they've said publicly and for many years now is that they have a customer lifetime value. So think of that as like a cash flow stream of all the different claims that a customer might have, the premiums that they're collecting, like into all over, like through the lifetime of a customer, backing out like assumed churn rates and assumed claims, cost to actually service that customer, like, with employee time and that sort of thing. So they've got an AI model that for every single customer projects out that cash flow stream based on all the risk profiles and the things that are unique to that, prospect. And basically says, okay, for this customer, I think the lifetime value is, let's say, I don't know, $900. Then they'll say, okay, the cost to acquire that customer is $300. So basically, there's an NPV of your cost of $300 and the NPV of the income, which is $300. That is, or which is $900. So that's a LTV to lifetime value to customer acquisition cost ratio of 3-to-1, which is like actually kind of insane when you think about those economics. Bradford, if there was
so let me clarify that. Is it 600 in profit after the marketing spend or 900 in profit after marketing spend?
600 in profit after the marketing spend. Yep, because it's the ratio of the lifetime value over the customer acquisition cost is 3-to-1. So that means a $600 profit.
Yeah.
But,
so you're going to ask me the question.
So I was going to ask you, like, if you could spend $300 today to buy an asset that's worth $900 today, would you do that?
As much as I could, as many times as I can, as often as I can.
You would max out that spend to like the maximum amount possible, and that's what Lemonade is doing. They are really increasing that spend as much as possible, so that they can get all these cohorts. So I mentioned they spent about $40 million in marketing spend this quarter. So if you think of I was doing this math in my mind the other day, and it kind of blew my mind. If you think of like let's take that same ratio that we talked about. So the implied profit on a present value basis for this quarter is $80 million. And so if you take that over 4 quarters, that's $320 million in a year just from kind of spending marketing spend at this level. So that implies that the market cap of Lemonade should increase by about $320 million per year, which is roughly 30% of the company's total market cap today. So I think what the market is saying is that they basically don't believe that these customer economics are real. I understand that skepticism, but I would say one of the things that gives me a huge amount of confidence is the fact that they basically have this third-party referee, a company called General Catalyst, which is actually funding this, this $40 million that they're spending. General Catalyst is funding 80% of that spend, and they have access in real time to all of the customer data, the projected lifetime value from Lemonade's model, the actual like payback. They've been doing this for I think 2 years now, so they've got like the first cohort has been paid back already. So they've seen how the predicted versus actual has come in, and the company is basically essentially underwriting these unit economics and saying, yeah, like this makes a lot of sense. They're participating in the downside. So if a particular customer cohort, the economics don't work out, General Catalyst can take a loss on that one particular cohort. So it's not traditional debt in that manner because they are participating in the downside of the actual operations of the company. So like you've got the company basically for many years now saying a lifetime value to customer acquisition cost of 3-to-1. You've got a third party basically saying like, yeah, like that's what we're seeing, and we've got better access to data than you customers do. And the stock is basically not reacting to this because it's going to show up in like the long tail of these customers. If you think of it as like a waterfall of customers, so like, this quarter you got like a stream of cash flows, then the next quarter another stream of cash flows, then another, and then like another, and going forward. Then like by the time you get 2 or 3 years out, you've got like this like chunk of all these cash flows from the cohorts that you invested in many quarters and many years ago, that all of a sudden, like now you're reaping the rewards of these customer benefits. This is the dynamic that I think is just not well understood or appreciated. Like if you look at the current earnings, like income statement, yet it's negative. I get like the skepticism, but if you go a layer deeper and understand the customer cohort economics and how they build up over time, meanwhile, like operating expenses flat as a board, like that is what's actually so exciting. So I think this company is very highly misunderstood and undervalued, not financial advice.
And what's crazy is Wall Street analysts don't do this kind of work. Like some reason they forget, like insurance companies have to pay up front to get their customers, whether it's paying an agent, 7% up front on an annuity, or your marketing spend for TV and all that stuff. Now Lemonade, their marketing spend is more direct. They're getting ads in front of people and measuring that. So let me kind of restate what General Catalyst is doing. So it's like General Catalyst has implanted Lemonade with a Neuralink and is reading like what's going on in their business. And so they have that they have the data feed, they have the real deal, and they see how these customer cohorts that they develop each quarter, how they evolve over time, how profitable they are. And then they've decided to like renew what they're doing. They decided to do more.
Expand it. Yeah.
Expand it. So they're like co-investing in Lemonade's growth, which if you own the stock, you do that as well.
Yeah. So, I mean, that's like, I can't think of another situation like this where like so key to the thesis is like the unit economics. And you've got this like third-party referee saying, yeah, third-party economics are good. Like it honestly is like, it's so reassuring as an investor to have that level of kind of like third-party auditing. Now, like they're getting paid very well for this. Like they're getting about a 16% IRR. And you might say, okay, that's egregious. That's like, almost VC kind of like risk. One, I would say you're right, but the super important thing is that it gives Lemonade capital flexibility because it's not recourse debt. That means that like if the cohorts like blow up and they've got, let's say, 200 million of debt outstanding, and there's some like huge hurricane that is like hard on the balance sheet, Lemonade's like off the hook for that. They don't have to pay that back if the customer economics don't work out. So from a regulatory perspective, that's extremely important because it allows them to expand more quickly than they otherwise would if it was recourse debt. So that's number one, why they're willing to pay so much. But number two is like if the unlevered, meaning like the return of the cohort, that 3-to-1 ratio, that like the return on that, the annualized return is something like 55%. So if you are essentially levering that 55% with a 16% cost of debt, essentially, you're turning that into like a triple-digit IRR on a levered basis, which is like bananas. And that's what allows Lemonade to acquire a lot more customers than they otherwise would if they did not have this structure. So from a shareholder perspective, it's a very good deal, even though you're paying, I would agree, a very high rate to General Catalyst.
Matt, what do you mean by a triple-digit IRR?
I mean, over 100% return per year. So, Lemonade, let's say Lemonade spent $2 million on, actually it wouldn't be that low, but for the sake of argument, let's just say Lemonade spends $10 million on their portion of the customer acquisition cost. Then those customer cohorts would be worth, would essentially be compounding at 100% plus per year. So your $10 million would be worth, 20 million at the end of year 2 and would be worth 40 million at the end of year 3, essentially. So it's like that is a level that is like so beyond what any normal company would have an opportunity to invest in. Like it's insane. Like when I was in the energy world, we were looking at IRRs in like the 12% range and being like, yeah, that's a good deal. I think like if you're looking at riskier investments, you'd be like, okay, like 20%, good chance it doesn't work out, but like that's still a good deal for me as like a private equity investor potentially. So to get something that's like 30 or that's over 100%, and it's not even just like a little bit over. I forget the numbers that Shai shared, but it's something like 150% per year IRR. Like that is like crazy territory, and it's so crazy that people don't take it seriously. And I think that's what we're seeing right now with the market.
So I think with a company like Lemonade, you have marketing expense, and it's really an investment. That's the way people should look at it. And though accountants wouldn't do this, like you would carry an investment at its value on the balance sheet, or like worst case, like for the same amount you put in. But actually it's worth more than that. But
capitalize it like a company buying a
factory,
a manufacturing plant. Yeah, like you would capitalize that, put it on your balance sheet, and depreciate it over time. Instead, Lemonade takes the entire hit up front.
So let's contrast that to what was that medical app that your doctor could Teladoc. Yeah, so Teladoc, they were spending more on their marketing spend than the value of the customer.
Not a winning strategy.
What's that?
Not a winning strategy.
Yeah, that's not good. So like in that point, in that case, like you definitely should not adjust it. Like you hold it against them. Absolutely. You think about Tesla when they build a factory, that's an investment in their future, and then they make the inventory from that factory. Like bare minimum, you hold those things at cost, and maybe you depreciate them over time. So like this is what we're trying to illustrate. I know people may not quite get it, and I think this complexity is actually what helps to create the opportunity for us.
Yeah, I mean, we were at the investor day back in November, and we're talking to some of the other analysts there, and like, what do you think about the AI? They're like, oh wow, like it's actually really good. I was a little skeptical, but I think they've legitimately got the chops. What do you think about the valuation? Oh, it's still a little high. We don't want to pay more than like 2 times book for a company. And I'm like, they've got these mental models that are like, the way that you look at an insurance company is by a multiple of their book equity. And I understand why mature insurance companies that have been around for 100 years that have positive net income and a growing book value would look at it that way. But when you like Lemonade's economics just look nothing like that. And so, looking at current book equity value as an indication of the fair value of the company just makes no sense. But to your point, like I think it does give us an advantage because we spent a lot of time thinking about this, and like we've thrown out various models over the years, and like I think what we've come to now reflects the kind of deep understanding that we have, and how I think to really understand the company, you have to model it on this cohort basis, where you're looking at every single group that's added of customers over time and kind of layering them together. Last point on that, and
let me add a point here. So Allstate is a boring insurance company. Year ending 2021, their total revenue was 50.6 million, or like 51 billion. I mean, 51 billion. Year ending last year, so 3 years later, was 64 billion. So it took them 3 years to grow their revenue by 25%. So they're growing their revenue less than 10% a year. So like I think it's even less than 8%. So let's contrast that to Lemonade for a second. I'll put you on the spot, Matt. I think their in-force premium growth was like something like 27%.
Or it was just shy of 27%. So they're kind of in the high 20% range on their growth. So certainly growing a lot higher. But I think the thing that's more compelling, like I wonder if you were to look at Allstate, like how has their operating expenses grown in that
That's a
same
good
period?
question. Yeah, I'll find that in a sec.
Okay, so I'll
Oh, here we go. So operating. Oh, it's a little complicated. I don't want to give a bad answer.
All right. So maybe I'll one other comment I've heard from a lot of people is like, okay, well, it's the insurance industry. Like that's not that exciting. It's not autonomous cars. It's not like humanoid robots. So like, how exciting is this really? Like the insurance industry is a big part of how Warren Buffett did so well. Go and check out a chart for Progressive. PGR is the ticker. If you go back to 1985 and look at the cumulative returns, it's just under 500,000% returns. So like the insurance industry, yeah, it can be boring, but like truly like massive returns are definitely possible because the space is just so large. So if you have a very well-run company that, you know, is great at pricing and has some operating leverage, I think the upside potential is quite enormous in the long term. It's not the sort of company that's going to like, they're not going to double or triple their business in a year because like they're not, that it is regulated. So there's that kind of, you know, boring piece of it. The growth rate is inherently going to be limited. But I think from an investor's perspective, I find it extremely compelling. And the one thing.
So Matt, I do have an answer for you. So their total expenses minus their what they call the policy acquisition expense 3 years ago was 38 billion. And at the end of last year, it was 50 billion. So that grew by around like 30%. So actually grew at a higher percentage rate than their total revenue.
That's like the opposite of operating leverage.
Yeah, so it's getting worse, and they're essentially their non-marketing expense grew by 12 billion, and their revenue grew by 14 billion. So that's not what you want to see.
No. And so these companies like Progressive is got $166 billion market cap. Lemonade right now is about $1 billion. A lot of the other companies in the space are in like the like 30, 50, $60 billion kind of range. And one of the things that just really is compelling in the long term, I think about Lemonade is the fact that like they're taking their medicine up front with these customer acquisition costs, but then they don't have any kind of like residual insurance broker fees that get paid into perpetuity. For a lot of insurance products, your agent will get a commission that's a set percentage of the premiums into perpetuity. So like if you're Progressive, and I don't know these numbers, so just take this as an example, but let's say you've got a 75% loss ratio, and then you're paying like a 9% commission to your agents on top of that. Like that leaves you with only like 84 or like I guess 16% of your overall premiums from which you can like have a profit and pay all of your expenses. With Lemonade, they don't have any of that because they own the economics for the lifetime of the customer, and there's no like premium sharing that they're doing with an agent that's taking a perpetual commission. So I think like the combination of that with their extremely compelling operating leverage, I think it's possible in the very long term, like if they're growing well into the 2030s and into the 2040s, I think they could be the largest insurance company out there in the world, which is like really saying something. And there's a lot of execution risk between here and then. So I'm not saying that will happen by any stretch, but there's at least a setup and I think a reasonable thesis to say they should be like at least competitive on pricing. They should have an edge in having no commissions, and they should absolutely have an edge in maintaining tighter control of their operating expense growth than their peers. So as they go from $1 billion to $10 billion to $100 billion in premium, their expenses shouldn't grow anywhere near that level. And that means like what's flowing to the bottom line would be much bigger as a percentage of revenues than their peers. So that's I think the long-term bull thesis.
And let me just clarify something. So we were talking about General Catalyst and how they share some of the upside with Lemonade. So essentially, General Catalyst, they get paid 16%. And so what'll happen is that it can be from anywhere from like 5 quarters or like a year and 3 months to like a couple of years. It depends on how fast things are recouped. But then like after that is done, General Catalyst for that customer cohort gets 0.
Yep.
It's not perpetual.
Yeah, exactly. Yeah. So and that's why we really think like the extreme pop and like the transformation of the financials is going to be kind of late this decade into the 2030s, where like you've reached this critical mass where, your marketing spend at, even if it's 40, 50, $60 million per quarter, if you've got 2 billion, 3 billion in force premium and like the kind of, you run the income statement with all those numbers, like the business would be at sufficient size then to kind of absorb that and kind of continue to grow. So another kind of strong quarter. Maybe the one thing we didn't touch on was car. We've been maybe slightly critical that they're not growing that as fast as they could have. And I think we found out some of the reason why. Their loss ratio on that is 88%, or at least was in Q1. That's an improvement. They were at 99%, I think, like a year ago. So they're making progress, but they're still not, in the kind of 75% range where they want to be. And I think seeing that is a good explanation of why they've not rolled that out a little bit more aggressively. I think the worst thing they could do is roll out car aggressively and then realize that there was some issue with their pricing model or their risk model, and all of a sudden have spent, let's say, $20 million acquiring some car customers that, oops, we thought it was a 3-to-1 lifetime value to customer acquisition cost ratio, but it turns out it's like a 0.8-to-1 or something like that. Like that'd be a very bad situation. So I think they want to like establish their confidence in their pricing, really get that honed in, and then once they feel better about that, then they can really hit the gas pedal on acquiring more car customers. And just for the record, this is something that they've seen in their other product lines where earlier versions of their AI pricing models were not as good. And so like over time, as they introduced like newer AI pricing models, or these LTV models that they call them, they got better and better at predicting risk, and their realized loss ratios came down accordingly. So it stands to reason that the same thing would happen with car, which is the kind of newest product that they're rolling out. So a lot there. We probably spent longer talking on Lemonade than most viewers would probably care for, but Tesla is not the only company that is misunderstood, and Lemonade is one that I think is just flying under the radar, and like the share price seems to like just get bounced around based on sentiment, not based on fundamentals, and we certainly saw that today.
Yeah. Unit economics are very important, and I think it's something that people don't delve into often. But this was something that excited me about Tesla. You had Sandy Munro tear down the Model 3, and he's like, okay, they're doing a lot of this stuff wrong. But if they clean things up, they can get costs to this level, is where we think costs roughly are. And they start this factory in China, they lop off a little extra costs. Their gross margin will be like something like 30% or something like that. So like this gave us confidence that when Tesla expanded from Fremont and added Shanghai, that they would become profitable. So that's why we added this stock a long time ago.
And more recently, talking about unit economics, we were just talking about the Robotaxi unit economics and how important it is to like deeply understand those unit economics in order to understand the investment opportunity. And I think so many investors out there have these like simplified mental models or little heuristics that they use, like oh, the Uber TAM, like it can't be that big of an impact to Tesla. It's like, no,
Mhm.
you're not looking at the unit economics. When you actually do it at that level, I think it gives you a much better understanding of how like a counterintuitive conclusion could be reached on a stock.
Mhm. Yeah. I
Well,
do want to talk a little bit about India. We can keep it pretty short, but rumors persist that India is looking to make a deal with the United States. India, in general, will be slightly controversial here, but people in India and China will agree with me. India does not like China. China does not like India. There's a pretty strong competition, rivalry there. At some points, there were border skirmishes. Um, I thought that India would be motivated to be one of the first countries to make a deal with the United States. And a Trump or someone in his administration is claiming that India has offered the U.S. A deal where they're dropping all import tariffs.
oh
Um,
wow,
I,
that'd be
I
a
think
big
there's
deal.
different deals on the table. We'll see what's true, what ends up happening. But I wasn't surprised to hear that, and um, curious to see or when we hear from South Korea again. Seems like Japan they do want to probably put some pressure on China, but they're waiting. And Europe is definitely concerned, like with Chinese the potential for Chinese goods to flood Europe. They don't
Mhm.
want like all this stuff that's got heavy tariffs. They don't want it to suddenly show up in Europe. And allegedly, some of that's happening in Canada, where they're getting a flood of Chinese goods, and the WalMarts and Amazons of the world are waiting until the tariff changes before they send it on to United States.
Oh, interesting. Jeez. Yeah,
Yeah.
it's there's a lot going on. Um, little side plug. If anyone hasn't listened to that interview Lex Friedman did with Narendra Modi, the Prime Minister of India, that was an excellent interview. I didn't really know much about Modi before, but it was really eye opening to kind of understand the politics of that country and the way that he's leading it. He's got a pretty ironclad grip on India and like the politics there, but I think he's actually doing things that the country really favors. And when you listen to him, I think he's comes off as quite reasonable. So
Mhm.
highly recommend listening to that if people have not.
We've done a thing with Farzad. People might start to be hearing about that. Farzad had a podcast with Sandy Monroe, and we begun to sponsor Farzad's channel. So you'll hear the occasional plug for Rebellionaire on Farzad's channel. I don't know if you want to share it, but you had a funny saying like about what Farzad said about that.
I actually don't even know what you're talking about.
It's like Farzad rips on you all the time, right?
Oh yeah. It was kind of for those who don't know, Farzad and I like we roast each other pretty constantly, and it's all in good nature. But like a lot of times on X, if you don't know, like it can come off as like pretty harsh.
Mhm.
um, so when Farzad and I were talking about this, and I was like, oh, like, but you'd have to say good things about me, so that might like break a part of your soul. And he's like, oh no, you can literally just pay me, and I will say nice things about you. So that was pretty funny. So no, Farzad does great work, and part of what we do with Rebellionaire is like sponsoring content creators who do really great content. I've got a huge amount of value out of what he does. We've been sponsoring Limiting Factor for a long time now. There's the Rebellionaire badges on a lot of content creators on X.
Mhm.
So we're kind of happy to get back to the community in this way. But yeah, sponsoring Farzad too will be another way to get our name out there a little bit. So yeah, if anyone is interested in learning about what we do with covered calls and trimming and adding and all the rest, you can check us out on rebellionaire.com. Check the contact us form if you're interested in learning a bit more about what we do. But it's been good.
And with that, I'm going to say bye for now.
Bye for now.